False pretenses. Under false pretenses, fraudsters trick property owners into signing over their deeds. This often involves sophisticated schemes where the owner is misled into believing they are signing documents for a different purpose, such as refinancing a mortgage, updating records, or another non-threatening transaction. The documents signed, however, are actually deed transfers or agreements relinquishing property rights. Victims typically realize the deceit only after the fraudster has taken control of the property or it is too late to reverse the transaction easily. Example 1. Refinancing scam. Scenario: Helen, a retiree, received a call from someone claiming to be from her mortgage company. The caller informed her of an opportunity to refinance her mortgage at a significantly lower rate. Excited about the potential savings, Helen agreed to meet with the representative to sign the necessary paperwork. The representative visited her home with a stack of documents, which he hurriedly explained were standard forms for refinancing. Fraudulent action. Amidst the stack was a deed transfer document cleverly disguised as part of the refinancing agreement. The document's language was technical and convoluted, designed to be overlooked or misunderstood by someone not well versed in legal jargon. Trusting the representative, Helen signed the documents without realizing that she was actually transferring ownership of her home. Outcome. Several weeks later, Helen received a notice from a different company claiming to be the new owner of her property. It was only then that she discovered the refinancing offer was a scam, and the supposed representative was a fraudster who had now sold her home to a third party. By the time Helen sought legal help, the fraudster had disappeared, and unraveling the fraudulent transaction became a complicated legal battle. Example 2. Property tax update trick scenario. Mark, a small business owner, was approached by an individual who presented himself as a tax assessor. The person claimed that there had been a reassessment of property values in the area, and as a result, Mark needed to update his property tax records to avoid penalties. Fraudulent action. The fraudster presented Mark with several forms, explaining they were necessary to update his tax records. Included in these forms was a document that resembled a standard government form, but was actually a deed transfer form. The form was filled with dense bureaucratic wording and appeared innocuous. Under the guise of updating tax records, Mark signed the document, unknowingly signing over his property to the fraudster. Outcome. A few months later, Mark received a letter from the county clerk's office regarding a change in the ownership records of his property. Confused, he investigated further and realized the supposed tax assessor was a con artist who had transferred Mark's property to himself and subsequently sold it. Mark was forced to engage in a lengthy legal process to attempt to reclaim his property, facing significant legal fees and the stress of potential permanent loss. Both examples showcase the deceptive methods used under false pretenses to trick property owners into unwittingly signing away their rights. These scenarios highlight the importance of vigilance and the need for property owners to thoroughly review all documents and verify the credentials of individuals claiming to represent legitimate entities before signing anything related to their property. Fraudulent deeds. Fraudulent deeds are crafted to look authentic and legitimate, but are entirely fabricated. These deeds might mimic real deeds in format and language, but are used to falsely represent property ownership. Fraudsters use these deeds to sell property illegally or to claim ownership, often complicating legal processes when the fraud is discovered. The challenge in detecting fraudulent deeds lies in their sophisticated creation, which often requires a keen eye and deep understanding of legal documents to spot inconsistencies or alterations. Example 1. Creating a fake historical deed. Scenario: in a historic district where real estate values are high, a fraudster named Alex decided to claim ownership of an abandoned property. Knowing the property had been unclaimed for decades, Alex crafted a fraudulent deed suggesting the property had been in his family for generations, but had been lost due to clerical errors in public records. Method: Alex meticulously studied old property deeds from the district archived at the local library to replicate the language, style, and type of paper used during the era he claimed the deed was originally made. He used aging techniques on the paper and forged a notary's seal from the period. Alex then presented this deed to the property registry, which initially accepted the document as genuine due to its authentic appearance and filed it without rigorous verification. Outcome: Alex began renovating the property, planning to sell it at a high profit. However, during a routine audit of property records by new staff trained in historical document verification, the deed was flagged for inconsistencies in the aging process and the notary details, which did not match other documents from the same period. The property was seized by authorities, and Alex faced legal charges for forgery and attempted fraud. Example 2. Selling property with a fabricated deed. Scenario: a small-time real estate investor, Brenda, noticed a foreclosed property that seemed forgotten by its bank owners. Sensing an opportunity, she decided to create a fraudulent deed to transfer the property to her name, intending to quickly sell it before the fraud was detected. Method: Brenda used her access to legal deed templates from her previous job at a law firm to create a new deed. She included realistic descriptions of the property and forged signatures from bank officials supposedly authorizing the sale. She also paid off a corrupt notary to provide an official stamp. With this deed, she registered herself as the new owner and listed the property for sale. Outcome: Brenda managed to sell the property to an out-of-state buyer who was unaware of the fraudulent nature of the deed. However, when the buyer attempted to take possession, the original bank contested the ownership, revealing that they had never sold the property. The fraudulent deed was examined, and discrepancies in the signatures and notary details were uncovered. The sale was voided, and Brenda was subsequently investigated and charged with real estate fraud. Both examples highlight the complexity and the criminal creativity involved in crafting fraudulent deeds, demonstrating the importance of diligent verification processes in property transactions to prevent such fraud. Use of straw buyers. The use of straw buyers involves individuals who, knowingly or unknowingly, allow their names and personal information to be used in property transactions. In the context of deed fraud, a straw buyer acts as a cover for the real perpetrator, making it harder to trace the fraud back to its source. Straw buyers might be convinced under false pretenses that they are helping in a legitimate transaction, or might be part of the fraudulent scheme themselves. Their involvement adds layers of complexity to property transactions, obscuring the identity of the actual fraudsters and complicating legal efforts to rectify the fraudulent activities. Understanding these techniques in detail is crucial for real estate professionals, property owners, and legal authorities to develop effective strategies to detect and prevent deed fraud. Awareness and vigilance are key components in safeguarding one's property against such sophisticated crimes. Detailed examples of the use of straw buyers in deed fraud. Example 1. Unknowing participation in mortgage fraud. Karen, a recent college graduate looking for work, was approached by an acquaintance with a seemingly simple job offer to act as a real estate investor. The acquaintance explained that due to some temporary credit issues, he couldn't purchase a property in his name and offered Karen a fee to use her name and credit history to secure a mortgage. Karen agreed, believing she was helping in a legitimate financial arrangement. The property was purchased using Karen's name, but the acquaintance then quickly sold it to another member of the fraud ring at an inflated price, a common tactic in mortgage fraud schemes. The second sale was financed by another fraudulent loan, which defaulted soon after. Karen was left as the nominal owner of a property deeply underwater in value, facing legal actions from lenders, with her credit destroyed. This use of a straw buyer allowed the real perpetrators to profit while shielding themselves from immediate detection and legal repercussions. Example 2. Organized crime involving straw buyers. In a more orchestrated scenario, a criminal organization sought to launder large amounts of money through real estate. They recruited several individuals from low-income neighborhoods, offering them a small percentage of the transaction value to act as property buyers. These straw buyers were often not fully aware of the purpose or the implications of the transactions. Using these straw buyers, the organization purchased numerous properties across the city. The deeds were then quickly transferred multiple times among various members of the organization, each time at higher prices, to create a false market boom in these properties. Ultimately, the properties were left to go into foreclosure or sold to unsuspecting third parties, effectively laundering the money and making it difficult to trace the original illicit funds. The criminals used sophisticated techniques to create seemingly legitimate trails of ownership and finance, while the real control and benefits were hidden among the members of the organization. This method not only obscured the origins of the money, but also exploited the straw buyers, who faced potential criminal charges and long-term financial ruin. These examples highlight how the use of straw buyers in deed fraud can vary from seemingly benign misuse of one's credit or identity to partaking in large-scale criminal enterprises. Both cases underline the importance of understanding the full scope of any real estate transaction and the potential for misuse of personal information, showcasing why diligence and verification are critical in protecting against such fraud.